Hey folks, Tom Norfleet with www.citizenshipquickly.com. This is our second part series on forming an offshore corporation to lower your taxes. I think what you'll find out is as you get older in life, you'll find out that moving from one country to the next, whether you're retired or running a business, will get old if you're doing this to just get around paying taxes in a country that taxes worldwide income. That's why you really should pick, if you're going to do this, pick countries to live in that are either pure tax haven countries or countries that have a territorial tax system. Most countries that have tax laws that tax worldwide income implement these tax laws on you. If you live in that country about 183 days a year or more every year, and this is, of course, every country is different on how they do this. If you're a U.S. citizen, the previous comment is obsolete because the U.S. taxes its citizens and its green card holders on their worldwide income, no matter if you've left the U.S. or not. And for green card holders, that card has to have been legally surrendered, or if you're not a green card holder, the IRS will look at the substantial presence test to see how long you've been residing in the USA to see if you're subject to your worldwide income. If you're an alien, not a U.S. citizen, you're considered a non-resident alien unless you meet one or two tests. You are a resident alien of the United States for tax purposes if you meet either the green card test or the substantial presence test for the calendar year, January the 1st to December the 31st. You can Google search the substantial presence test to get the most up-to-date law on this matter, but generally you should not stay in the USA more than about 120 days a year to play it safe, or the substantial presence test would have been violated. If all of your income is coming outside of the country where your company was formed, such as Hong Kong, then a Hong Kong company might be your best choice. You have to look at these fees to set up and run the company. Where is your income, or at least the majority of your income, coming from, and what are the taxes on that income, preferably zero, and what's the reputation of that country? Panama has great tax laws, but then Panama does have the prestige that does not have the prestige that a Hong Kong company offers. Plus, Panama has been bullied around by the OECD, which is the Organization for Economic Cooperation and Development, for years. Panama also has a hiring requirement for a certain number of Panamanian employees, which is a cost factor that Hong Kong does not incur on you. And this can cost you a lot, and these are factors you really have to look at. The OECD group of countries are composed of 36 countries, most of which are high tax countries and want other countries to have high tax laws also on individuals and companies. Panama is so dependent on these countries, even using the US dollar as their currency. Panama seems to give in almost every gesture that is thrown on them by this organization, whereas Hong Kong is owned by China and doesn't really have the pressure. So this is something you really have to look at. Hong Kong also does have its own separate legal system from China, and China is one of the few countries that does not let the OECD bully them around. So this is a big factor you need to take in consideration. I would have to consult with you and determine, based on your business model, what is the best option for you. You would never want to set up a St. Kitts corporation because the corporate tax rate in St. Kitts is 33%. Unincorporated, like I say, unincorporated is the way to go if you pick St. Kitts and Nevis as your option. But again, your goal should be as close to zero taxes no matter what country you choose. But meeting your goals of your business is your main option. Example of countries that have a territorial tax system in place. These are countries that tax income only inside the country and not outside the country. These countries are Nicaragua, Panama, Belize, Costa Rica, Paraguay, Ecuador, Singapore, Thailand, Guatemala, Hong Kong, Gibraltar, Macau, Malaysia, San Marino, and Montenegro. I would be wary of the last country I mentioned, which is Montenegro, because they've applied for EU membership. And once they get this membership, more than likely they will be required by the EU to tax individual residents on their worldwide income. Believe it or not, in most cases, you will pay out a lot less in taxes if your company is set up and your personal residence is in a country that has a territorial tax system than actually using a pure tax haven, as long as you're retired or your income is made outside the country where your business is actually incorporated. An example would be, let's compare Panama and St. Kitts. St. Kitts has a duty of 53% when you bring in goods and services into the country. A car that you bring in, if it's over 2 years old, has even a higher duty at about 80%, but no worry about this because those cars can be picked up in Japan for only about $400 US before being shipped into St. Kitts with only about 15,000 miles on them. These are cars that are about 10 to 15 years old with incredibly low mileage because Japanese don't use their cars much on the weekends. They get to work by public transit. By the time that car is shipped into St. Kitts, that $400 US car is now about $6,900 US, including the VAT, import duty, environmental duty, and freight. But then you got a car that has low mileage for about $6,900 US. Houses have similar high duties when bringing in supplies to build, except a property that you use to qualify you for citizenship in St. Kitts and Nevis, because the materials to buy that house is duty-free since you bought it, to get citizenship in St. Kitts and Nevis. The reason these other taxes are so high is there is no individual income tax in St. Kitts and Nevis, and only an unincorporated business tax of 4%. The money's got to be made up somewhere, but remember, a spending tax can always be avoided by not buying the item or buy it used or cut your own deal with whomever you buy it from. This way the government's left out and the taxes left out. If you got a lot of income, then St. Kitts would be better than Panama. And when I say a lot of income, this is a lot of income coming to your business locally. Then St. Kitts would be your better option than Panama if the income is the same in both places, because Panama's got a 25% tax rate and a 22.5% Social Security tax, but you escape all this if your income is made outside of Panama. The cost for food and building materials is cheaper in Panama than St. Kitts and Nevis. As far as total taxes go, I would pick Ecuador over Cayman Islands if you're trying to pick the country to live in that has the least overall taxes. Both countries, you'll pay no individual tax or corporate tax if your money is made outside the country, but a lot of import duties and fees you would incur in the Caymans you would not have in Ecuador. Ecuador does have an income tax for income made inside Ecuador, and this makes up for these high import duties and fees which the Cayman Island charges, which are basically taxes. But you would avoid the local income tax in Ecuador by your income being made outside the country. These are just some points that you need to look at. If you got a question or comment, if you will hit the comment section below. Also, if you would like new videos, just hit the subscribe button and we'll get the new videos out to you as soon as possible. This is the second part series of our videos on this subject. And if you got a question, just send it to us, and I look forward to talking to you on the next video. Thank you.